Hello students and welcome to the lecture. So students, as we know that we are covering the banking awareness practice question and this is going to be our part 5. Like in the previous lecture we had talked about the part 4. In this lecture we are going to talk about the part. The pattern would be the same. Like we will do some practice questions and at last we will see the summary of all the questions that we have looked at. Okay. But before starting this, as usual, we have our small disclaimer presented over here. And the disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the image. Now, after understanding the disclaimer, let's begin with the question number 1. Who among the following are eligible to issue the commercial papers in India? Corporates, primary dealers, all India financial institutions, all of the above, none of them. To answer this, you will have 10 seconds. You can answer. Your time starts now. Okay, the time's up. The correct answer is D. All of the above. If we go by the explanation, we could say in India, the following entities are eligible to issue the commercial papers or CPs. Like first, corporates. Established companies could issue the commercial papers to meet their short-term financing needs. Primary dealers. These are entities authorized to deal in government securities could also issue the commercial papers. Third, all India financial institutions. Institutions like National Bank for Agriculture and Rural Development, NABARD, and others also allowed to issue the commercial papers. Since all the entities eligible to issuing the commercial papers, the correct answer is B, all of the above. Question number 2. Which of the following is not an advantage of unit banking? They have fast decision making. The management enjoys more autonomy. They have risk diversification. All of our are advantage of unit banking. None of. Again, to answer this question, you will have time period of 10 seconds and I will give you the answer. So your time starts now. Time's up. Correct answer is C. They have risk diversification. Go by the explanation. Unit banking refers to a banking system where a single bank operates from one location without branch. Here is a breakdown of options. First, they have fast decision making. True. Unit banks have fewer layers of management, allowing for quick decision making process. Then, the management enjoys more autonomy. True. Since unit banks operate independently without branches, local management has greater autonomy over operations. Third, they have risk diversification, not an advantage of unit banking. Unit bankings are typically more exposed to the risk since they operate from a single location, do not have a diversified portfolio of branches to spread their risk. Then, all of the above are advantages of unit banking. Incorrect, as option C is not an advantage. Then, none of these. Incorrect, as option C is the correct one. So, therefore, the option that is not an advantage of the unit banking is C. They have risk diversification. Question number 3. With reference to the various types of banking, what we call as a mixed banking. Options are when banks undertake the activities of commercial and investment banking together, when banks undertake the activities of wholesale and retail banking together, When banks undertake the activities of offline and online banking together. When banks undertake the activities of commercial and cooperative banking together, then none of this. To answer this, again, the conditions are same. You will have 10 seconds to answer. Then I will give you the answer. Time starts now. Time's up. The correct answer is A. When banks undertake the activities of commercial investment banking. Just go by the explanation. Mixed banking refers to a banking model where financial institution engages in both commercial banking and investment banking. First is the commercial banking. Typically involves accepting deposits, providing loans, offering basic financial services to individuals and businesses. This includes services like savings and checking accounts, personal loans, and mortgage. Investment banking, on the other hand, involves activities related to the underwriting, facilitating mergers and acquisitions, helping companies raise capital through the issuance of stocks and bonds. By combining these two functions, mixed banks could offer a wider range of financial services and cater to the different client needs, allowing for more comprehensive financial solutions. This integration could lead to a greater efficiency and synergies within this system. So the other options listed do not accurately define mixed banking, making A the best choice. Question number 4. In terms with banking sector, anywhere banking refers to the customer could deposit, withdraw cash at any branch other than the branch in which he holds the account. The customer could deposit, withdraw cash at any bank other than the bank in which he holds the account. Customer could deposit, withdraw cash in foreign countries. Customer could deposit, withdraw cash at all one points of sale. None of these. To answer this, you have 10 seconds and your time starts. Okay, the time's up. Correct answer is A. The customer could deposit, withdraw cash at any branch other than the branch in which he holds the account. Just go by the explanation. Anywhere banking refers to a banking service that allows customer to access their account, perform transaction at any branch of the bank, not just the one where they opened their account. This means the customer could deposit or withdraw cash and access other banking services from multiple locations, providing greater convenience and flexibility. The other options do not accurately capture the assurance of anywhere banking, primarily focus on the ability to perform transactions across different branches of the same bank. Question number 5. Which among the following types of banking is most helpful in cross-selling? Options are virtual banking, relationship banking, wholesale banking, personal banking, none of these. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is B, relationship banking. Go by the explanation. Relationship banking focuses on building long-term relations with clients, understanding their needs, providing tailored financial solutions. This approach is highly effective for cross-selling, as bank could offer additional products and services that align with the specific financial needs of the customer. For example, if a bank having a strong relation with a client who has a mortgage, it could more easily cross-sell related products like insurance, investment opportunities, or retirement accounts. The trust and familiarity established through relationship banking make it easy for banks to introduce and sell complementary services. Question number 6. In which of the following types of banking there is a direct execution of transaction between a bank and its consumers? Retail banking, universal banking, virtual banking, unit banking, none of these. To answer this, you will have 10 seconds. Think and answer. Time starts now. Okay, the time's up. Correct answer is A. Retail banking. Go by explanation. Retail banking refers to the provision of banking services directly to individual consumers rather than businesses or large institutions. In retail banking, customer could execute transactions such as deposit, withdrawals, loans, and other financial services directly with the bank. This interaction often occurs at bank branches, ATMs, through online platforms specially designed for customer. The other options may involve different banking practices but do not primarily focus on direct consumer transactions in the same way that retail banking, like universal banking, includes a broader range of financial services but does not necessarily imply direct interaction with consumers. Virtual banking involves online services, but the term does not explicitly denote direct transactions. Unit banking typically refers to a banking model with a single branch, but it may not emphasize direct execution of transactions as clearly as retail banking does. Okay. Question number 7. A commercial bank will launch a medium-term note program to provide loans, raise funds, sell equity, purchase shares, none of this. Again, you will have 10 seconds to think an answer, then I will give you the answer. Time starts now. Alright, the time's up. Correct answer is B, raise fund. Go by the explanation. Medium-term note program is a way for a commercial bank to raise funds from the capital market. These are the debt instruments that allow the issuer to offer notes to investors with maturities typically ranging from 1 to 10 years. By launching an MTN program, the bank could issue these notes to attract investment and thus raise capital, which could be used for various purposes such as lending, financial projects, or improving. Other options do not accurately reflect the purpose of an MTN program. First, provide loans. MTN is not directly about providing loans, but rather about securing funds. Sell equity and purchase shares. Both involve equity markets, which are different from the debt markets where MTNs are issued. Primary goal of MTN program is to raise. Thereafter, question number 8. Which among the following is not a pillar of Basel III? Minimum capital standards, supervisory review, market discipline, consolidation of assets, none of these. To answer this, we will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is consolidation of assets. Go by the explanation. Basel III is a set of international banking regulations developed by the Basel Committee on Banking Supervisions, BCBS, to strengthen the regulation, supervision, and risk management within the banking sector. It is built around 3 main pillars. First, minimum capital standards. This pillar sets higher capital requirements for banks to ensure that they could absorb losses, remain solvent during economic turnouts. Supervisory review. This pillar focuses on regulatory framework for banks, emphasizing the importance of adequate risk management practices and the supervisory authority's role in evaluating banks' capital adequacy. Third is market discipline. This pillar encourages transparency and the disclosure of relevant information to the market, allowing stakeholders to make informed decisions and exert pressure on banks to maintain the sound practices. Consolidation of assets is not one of the pillars of Basel III. Instead, it might refer to the various accounting of financial practices but does not fall under the core principle established by Basel III framework. Question number 9. Capital adequacy ratio is a thermometer of banks' health. It is a ratio of banks' capital to its risk, risk to capital, capital to assets, capital liabilities, none of this. Answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is capital to its risk. Go by the explanation. The capital adequacy ratio is a measure used to assess a bank's financial strength and stability, defined as the ratio of bank's capital to its risk-weighted assets (RWA). Purpose of CAR is to ensure that the bank could absorb a reasonable amount of loss and compliance with the statutory capital requirements set by the regulators. The capital refers to the funds that a bank has available to cover potential losses. Risk-weighted assets consider the different levels of risk associated with the various types of assets held by the bank. Question number 10. Which of the following types of risk issued in the calculation of capital risk weighted assets ratio CRAR? Credit risk, market rate, operational risk. Like options are only one and two, only second and third, only one and third, only one second and third, none of these. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is D. Go by the explanation. The capital to risk weighted asset ratio, also known as capital adequacy ratio, is a measure used to assess the bank's capital adequacy in relation to its risk exposure. The risks that are considered in the calculation of CRAR including credit risk, the risk of loss to the borrower's failure to repay a loan or meet contractual obligation. This risk is a major component in calculating the risk-weighted assets. Market risk of losses in position arising from movements in market practices. This includes risk related to the interest rate, equity prices, and foreign exchange rate. Operational risk of loss resulting from inadequate or failed internal processes, people and system, or from external events. This type of risk is also factored into the calculating of CRAR. Okay, so option D is correct. For the first time, in which year the Basel Committee came up with the capital accords for banks? 1985, 1988, 1990, 1992, none of these. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is B. 1988. Go by the explanation. The Basel Committee on Bank Supervision introduced the first capital accord in 1988, known as Basel I. This framework established international standards for capital adequacy for banks, aiming to ensure that they maintain sufficient capital to cover their risk exposures. It is a set out the minimum capital requirements for banks, focusing primarily on credit risk. This accord was a significant step in the international banking regulation, as it sought to create a level playing field among banks in different countries and enhance the stability of the global banking system. Subsequently, revisions and updates led to the development of Basel II and Basel III, which introduced more comprehensive frameworks addressing the various risks. Therefore, the correct answer is 1988. Question number 12. Which among the following is not a part of Tier 1 capital? Issued capital, fully paid up capital, disclosed reserve, undisclosed reserve, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is undisclosed reserve. Go by explanation. Tier 1 capital, also known as core capital, consists of a bank's most liable financial resources. Primarily includes issued capital, the total amount of shares that have been issued by the banks. Fully paid up capital, capital that shareholders have fully paid for and is considered a part of Tier 1. Disclosed reserves, retain earnings and other reserves that are disclosed in the financial statement. Undisclosed reserves, on the other hand, are reserves that are not reported in the bank financial statement, typically not included in Tier 1 and Tier 2 because they lack transparency and can reduce uncertainty about the bank's true capital position. Question number 13. If the RBI adopts an expansionist open market policy, that means that will buy, sell securities from non-government holders, sell securities in the open market, offer commercial banks more credit in the open market, openly announce the market that it intends to expand credit, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is C. Go by explanation. When the RBI adopts an expansionist open market operation policy, aims to increase the overall money supply in the economy, while buying securities from the market, it is a common method. Offering commercial banks more credit in the open market is also a significant aspect of expansionary policy. Offering more credit. By providing more credit to commercial banks, the RBI encourages them to lend more to businesses and consumers. This is done through mechanisms such as repo operations, where bank could borrow money from the RBI by providing government securities as collateral. The increased credit availability allows banks to expand their lending activities, which stimulates the economic growth. Increasing liquidity. When RBI offers more credit, it injects liquidity into the banking system. This means banks have more funds to lend, which could lead to the lower interest rate and increase borrowing and spending in the economy. Question number 40. As we all know, when we deposit a check instead in our name in the bank always check if the check has been crossed or not. Why it is done? Options you have in front of you. You have 10 seconds to think an answer. Time starts now. Time's up. Correct answer is A. It ensures that the money is deposited only in the account of the person whose name the check has been drawn. Got my explanation? When check is crossed, it means that two parallel lines are drawn on the top left of the corner. This crossing serves as an instruction that a check cannot be cashed directly at the bank's counter. Instead, it must be deposited in the bank account. Protection against fraud. Crossing the checks adds a layer of security. This ensures that only the person whose name is on the check could deposit it into the bank account. This reduces the risk of check being misused or encashed by someone else. Endorsement requirement. If check cross generally requires the person to whom the check is made out to deposit it through their bank account rather than cashing it directly. This ensures that the funds are properly accounted for and trust. Regulatory compliance. While specific rules could vary by jurisdiction, the practice of crossing checks widely accepted as a standard banking protocol aimed at safeguarding both the payer and the pay. Question number 15. Which of the following terms not associated with the banking operations? Repo rate, prime lending rate, equator, cooperative finance, cash reserve ratio. 10 seconds you have to answer. Time starts now. Equator. Explanation. Repo rate is a rate we learned about like a central bank lends money to the commercial banks, typically in context of monetary policy and liquidity management. Prime lending rate, interest rate that commercial banks charge their most credit-worthy customers. It's an important benchmark for loans and interest rates. Corporate finance deals with funding and capital structure of corporations, including investment strategies, managing financial risk. Cash reserve ratio, percentage of a bank's total deposit that must be held in reserve with the central bank, influencing liquidity in the banking system. Equator, while this term refers to an imaginary line around the earth, not related to the banking operation, does not pertain to financial concept or practices. Question number 16. A student has got admission to a foreign university from where he can she get the foreign currency. Options you can see here. 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is D. Go back explanation. When a student needs to obtain foreign currency for tuition fees, living expenses, or other costs associated with the studying abroad, they typically do so through authorized foreign exchange dealers, financial institution or entities authorized by the central bank or regulatory authority to deal in a foreign exchange, could provide the necessary foreign currency, ensuring compliance with regulations and offering competitive rates. Question 70. Which of the following is not a government-sponsored organization? These are the options. You have 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is ICICI Bank. Go by explanation. First is SATHEE. It is a government-sponsored institution aimed at promoting and financing small-scale industries. Then NABARD. It is a government development bank that focuses on financing and supporting rural development activities, primarily in agriculture. NHB. It's a government-owned bank that regulates and promotes housing finance in India. ICICI Bank. Private sector banks originally established as a development financial institution but not operate as a commercial bank, not as government sponsored. So all are government sponsored. This option is incorrect because not all the institutions listed are government sponsored. Question number 18. Which of the following is the apex institution which handles refinance for agriculture and development in India? RBI, SIDBI, NABARD, CB, none of these. 10 seconds you have. Time starts now. The time's up. Answer is NABARD. Go by explanation. NABARD stands for the National Bank for Agriculture and Rural Development. which is an apex institution in India that primarily focus on providing refinance for agriculture and rural development. Got established in 1982 to finance and support rural development activities primarily in agriculture and rural infrastructure. RBI regulates the banking sector in India, plays a role in monetary policy, not specifically focused on agriculture and rural development. SIDBI primarily supports small and medium enterprises, not the main institution for agriculture finance. SEBI regulates the security market in India and has not direct role in agriculture finance. So the NABARD is the correct answer. Question 19. Which of the following is not a part of India's money market, bill market, call money market, banks, mutual funds, Indian Board Council? 10 seconds you have. Time starts now. Time's up. Correct answer is Indian Gold Council. Indian Gold Council is an organization focused on promoting gold and does not engage in money market activities. 20. Teaser rate related to which of the following types of loan? Home loans, personal loans, auto loan, reverse mortgage loans, crop loans. 10 seconds you have to think and answer. Time starts now. The time's up. Correct answer is A. Home loans. Go back explanation. Teaser rates often issued with the home loans. It is a temporary interest rate that's set lower than the standard market rate for a specific initial period, typically to attract borrowers. After this period, the rate usually adjusts to a higher variable rate. Home loans. Many lenders use teaser rates to make their home loan offering more attractive to potential borrowers. These could help them secure a loan in a competitive market. Personal loans, auto loans, reverse mortgage loans, and crop loans. These type of loans may also have promotional rates. They typically do not feature teaser rates in the same way as home loans. Teaser rates more commonly associated with the adjustable rate mortgages. Question number 21. As we all know, the major source of income of the bank is lending money, providing credit, and earning interest on it. In normal circumstances, the demand of the credit comes mainly from the which of the following sector? Personal loan, priority sector lending and bailout packages, project. 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is D. Personal loan is a major sector for banks as individuals often seek personal loan for various reasons like buying car, financing education, making home improvements. Demand for personal loan is constantly high and contributes significantly to the bank's income from it. Priority sector lending and bailout packages refers to loans given to sectors that are considered important for economic development like agriculture, small industries, etc. Government often encourage banks to lend these sectors by providing certain incentives. Additionally, during financial crisis, banks may provide bailout packages to stabilize key industries, which could also generate interest rate. Project finance involves funding large interest projects or developments. Banks provide loans for these projects expecting the steady return in the form of interest rates over the long term. Given the scale of investment often required, project finance is a significant avenue for banks to earn interest. 22. Many banks have floated their subsidiaries which are fully owned by them. Bank loan subsidiaries normal for which of the following businesses? Home loans to sell insurance policies to control online operators as internet banking features. You have the options. 10 seconds you have to answer. Time starts now. Time's up. Correct answer is this one. Home loan business. Many banks establish subsidiaries that establish in providing home loans. This allows them to focus on the specific market segment, offering tailored products and services. Banks often create subsidiaries or joint ventures in the insurance sector. This subsidiaries allows banks to offer insurance products alongside their banking services, capitalizing on their existing customer base. To control online operations or internet banking business. Some banks create subsidiaries to manage their digital operations or internet banking. This separation could help in better focus innovation compliance with regulatory requirements related to the online banking service. Question number 23. The set of directive principles issued by the central bank of a country or the process required to control the supply of money, availability of money, cost of money, rate of interest, etc. in order to bring stability and growth of the economy are commonly known as monetary policy of the central government, budget of the government, profit and loss account, business policy of the government, none of the above. 10 seconds you have. Time starts now. Time's up. Correct answer is A. Monetary policy of the central bank of the country. Explanation. Monetary policy refers to the action taken by a country's central bank to control the money supply, interest rate, and availability of credit. The primary goal of monetary policy is to achieve macroeconomic objectives such as controlling inflation, stabilizing the currency, and fostering economic growth. Central bank issue directives and adopts various tools such as open market operations, the requirements, interest rate adjustment to influence the economy. Budget of the government refers to the government annual financial plan outlining revenue expenditure, does not directly relate to the controlling the money supply or interest rate. Profit and loss account. Financial statement that summarizes the revenue, cost, expenses incurred during a specific period, showing the profitability of business, not related to the monetary control. Business of the bank. While banks do have business policies, these typically pertain to the operational aspects of the banking rather than overreaching monetary policies. None of the above will be automatically incorrect if option A is correct. Question number 24. Consider the following statements. In a call money market, funds borrowed and lent for 1 day and for a period of up to 14 days without any collateral security. Ways and means advances made out the commercial banks to maintain mandatory reserves. Treasury bills are promissory note issued by the state government for fixed period standing up to 1 year. Which options are incorrect? Correct. 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is only one. Question number 25. Consider the following statement about open market operations is that open market operations stand for purchase and sale of government securities by RBI to the public and banks. RBI buys all the unsold stock new government loans at the end of the subscription period. Such purchase of government securities by RBI constitute only an integral arrangement and not genuine market products. 10 seconds you have to think and answer. Time starts now. Time's up. Correct answer is C. All of the above are true. Go by explanation. First, open market operations stand for the purchase and sale of government securities by RBI from to the public banks. This is correct definition of OMO because RBI conducts OMOs to regulate the money supply and interest rate by the buying or selling government securities in the open market. Statement 2. The RBI buys all the unsold stock of new government loans at the end of subscription period. False. While the RBI may purchase government securities as part of commerce, it does not automatically buy all the unsold stock of government loans. The buying of unsold stocks would be a separate arrangement and not a standard practice under OMO. Statement 3. False. OMOs are genuine market transactions. When the RBI buys or sells government security, participates in the market, these transactions influence liquidity and interest rate in the economy. So with this, we have finished the topic. Now it's part for the summary. We have talked about eligibility to issue commercial papers in India, unit banking advantages, mixed banking definition, anywhere banking concept, cross-selling in banking. Direct transaction banking, medium-term note, program purpose, Basel 3 pillars, capital adequacy ratio, CRAR risk types. Year Basel Committee capital accord established, Tier 1 capital components, expressed open market operation policy, check crossing purpose, term not associated with banking operations. Foreign currency acquisition for education, not a government-sponsored organization, Apex Institute for NABARD and deployment, not a part of India's money market, teaser rates loan. Main credit demand source, bank stability purpose, monetary policy definition, correct statement of call money markets and others, true statement about open market operations. With this note, we have finished this topic. It is requested to all of you kindly revise the facts and figures that all we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.